The dominant market story frames central bank gold buying as routine diversification, a cosmetic rebalance, a footnote to rate policy. That framing persists because it avoids mechanism. It treats balance sheets as abstract containers. It ignores how institutions behave under constraint. The common assumption is optionality remains wide, that reserves can rotate freely, that nothing fundamental is being signaled. This assumption survives because recent calm allows it. Low volatility supports denial. Price stability masks structural movement. Gold accumulation is therefore explained as preference, a taste shift, an insurance policy with no urgency. That explanation is shallow. It relies on intent, not necessity. Intent is not binding. Central banks do not accumulate hundreds of tons for preference. They accumulate under pressure gradients. Pressure leaves signatures before outcomes. Recently, official sector purchases exceeded 700 tons annually, a material share of global supply. This is not portfolio noise. Such scale requires coordination with physical markets. It cannot be executed invisibly. It reshapes flows. The popular response is to point at emerging markets, to claim developmental catching up, to reduce motive to status. That response avoids system symmetry. It implies advanced issuers face different rules. They do not. Reserve assets serve settlement, not yield. They anchor interbank trust. Trust degrades asymmetrically. The illusion is that trust decays slowly, that it signals through headlines. It does not. Trust collapses locally, then spreads. Institutions adapt before acknowledgement. Gold moves before language changes. Media narratives treat gold as relic, a hedge for outdated fears. That narrative persists because it reassures. Modern central banking claims flexibility, unlimited balance sheet expansion, infinite swap lines. These claims depend on counterpart acceptance. Acceptance is conditional. Conditions are tightening. Gold bypasses acceptance. It clears without permission. That property matters only under strain. The misconception is that strain must be visible, that it must express through crisis. Systems rarely warn loudly. Accumulation precedes stress because procurement is slow. Physical markets move with inertia. Delay is costly. Central banks plan years ahead. They front-run constraint. They do not wait for confirmation. Another common belief is that gold buying reflects inflation fear, a hedge against consumer prices. This is incomplete. Inflation metrics are domestic. Reserve strategy is external. Different problem sets. Gold does not hedge CPI. It hedges settlement risk. That distinction is avoided. The system prefers to speak in rates. Rates are adjustable. Settlement is not. Paper reserves dominate discourse. They scale instantly. They assume frictionless rollover. Physical reserves do not. They require custody. They impose limits. The market illusion is equivalence. That paper claims and physical assets substitute cleanly. They do not under stress. Gold exposes that asymmetry. It is final settlement. It reveals hierarchy. Another illusion is that dollar dominance is binary, on or off. This simplifies debate. Dominance erodes through margin, through haircuts, through access conditions. No announcement is required. Usage patterns shift quietly. Gold reappears at the edges. The assumption that nothing has changed rests on liquidity. Markets still clear. Funding remains available. Liquidity can persist while trust degrades. These are not identical states. They decouple. Central banks respond to decoupling first. They cannot afford surprise. Their mandate enforces caution. The media frames gold buying as geopolitical signaling, a message between rivals. This is reductionist. Geopolitics is episodic. Reserve architecture is structural. Structure outlasts narratives. Gold flows follow clearing needs, not headlines, not speeches. Another widespread belief is reversibility, that gold can be sold back easily. That accumulation is temporary. Physical accumulation embeds friction. Storage contracts. Transport logistics. Reversal is slower than entry. This matters institutionally. It raises the bar. Central banks know this. They do not trap themselves lightly. Each ton implies commitment. Recent purchases reached tens of millions of ounces. This is not tactical. It is infrastructural. Markets ignore this because price response was muted. No explosive rally. No visible panic. Price is not the signal. Flow is. Flow precedes repricing. Gold price stability misleads analysts. They equate calm with irrelevance. They misread function. Gold is accumulated to be boring. Volatility would defeat its role. Silence is success. Another illusion centers on reserve adequacy. That existing buffers suffice. That redundancy exists. Redundancy is shrinking. Cross-border claims overlap. Correlation rises quietly. Central banks see correlations before markets do. They run stress internally. They act preemptively. The belief that swap lines replace reserves persists. That trust can be extended infinitely. This is conditional. Swap lines are discretionary. They rely on alignment. Alignment is not guaranteed. Gold requires no alignment. That difference grows in value, especially when alignment frays. Some argue gold buying reflects nostalgia, a return to old anchors. This trivializes constraint. Modern finance still requires settlement finality. No code replaced that. No ledger solved trust. Digital systems increase speed. They do not remove hierarchy. Hierarchy still settles. Gold sits at the bottom. It ends chains. That role is resurfacing. The illusion of optionality remains strong. That central banks can choose later. Choice narrows before recognition. Accumulation signals narrowing. Not closure, but less comfort. The system still functions. Trades clear. Rates transmit. Yet behavior is shifting under the surface. Institutional memory is active. History informs procurement. The narrative gap persists because nothing broke. Breakage is not required. Preparation comes first. Gold buying is framed as defensive. Defense implies reaction. This is misaligned. It is positional, a response to gradients. Gradients are forming. Official data confirms scale. Annual purchases near record levels. This locks attention. Such scale cannot coexist with indifference. Someone is paying cost. Cost implies motive. The motive is not fear. It is arithmetic of settlement. Arithmetic accumulates silently. The public debate remains distracted by price, by charts, by commentary. Institutions watch inventory, custody, flow consistency. These variables are tightening, not collapsing, tightening. The system remains open. Liquidity still flows, but tolerance is thinner. Comfort is fading quietly. No alarm is sounding. Adjustment has begun. Attention now shifts from balance sheets to logistics, from entries to inventory, from claims to custody. Gold does not appear by ledger entry. It must be mined, refined, transported. Each step imposes delay. Industrial throughput sets the ceiling. Paper ignores ceilings. Metal does not. The market treats supply as elastic, responsive to price. This is inaccurate. Mine output changes slowly. Permitting stretches years. Energy inputs are fixed. Refining capacity is concentrated. Throughput is finite. Bottlenecks persist. Transport adds friction. Insurance adds cost. Settlement adds delay. These frictions are usually invisible. They surface only under volume. Volume has increased. Official sector demand now absorbs a material share of global supply. This is not marginal. It alters availability. Private markets feel this indirectly. Bars move slower. Spreads widen quietly. The paper market remains liquid. Contracts roll. Quotes update. But paper clears by netting. Metal clears by delivery. These processes diverge under load. Futures imply abundance. Warehouses impose limits. Limits are being tested. The assumption is convergence. That paper and metal reconcile smoothly. This holds only at low stress. As demand concentrates, reconciliation weakens. Delivery queues lengthen. Allocation tightens. Recent trades cleared at double-digit premiums in physical hubs. Not everywhere. Enough to register. Premiums signal strain without headlines. They reflect scarcity, not panic. They appear before repricing. The system explains this away as logistics noise. Seasonal distortion. Temporary mismatch. Temporary mismatches persist when capacity is fixed. They become structural. Recognition lags. Another belief is substitution. That other assets can fill gaps. This is constrained. Not all reserves clear globally. Not all claims settle bilaterally. Gold does. Industrial users compete with monetary demand. Electronics. Medical applications. They cannot bid infinitely. Margins cap demand. Official buyers are price insensitive. This asymmetry matters. It shifts allocation priority. Industry yields first. Recycling is cited as relief. Scrap returns. This is limited. Scrap flows rise with price volatility. Volatility remains contained. Supply response stays muted. Central banks prefer large bars. Specific purity. Specific form. Scrap does not always qualify. Conversion consumes capacity. Capacity is already loaded. Vaulting capacity concentrates in few jurisdictions. Custody contracts lock space. Exit is slower than entry. Paper markets assume fungibility. Any bar equals any bar. Custody rules disagree. Geographic mismatches emerge. Metal sits where it is stored. Claims circulate elsewhere. Transport corrects this slowly. Security constraints apply. Regulatory friction intervenes. The system tolerates this under low volume. Tolerance erodes as volume rises. This is observable. A growing annual deficit separates mine output from demand. Not catastrophic. Persistent. Deficits draw down inventories. Inventories anchor confidence. Anchors thin. Official holdings do not re-enter circulation. They are inert. They reduce float. Float reduction tightens markets non-linearly. Small changes matter. Elasticity drops. The belief that central banks can lease gold freely persists. Leasing requires counterpart trust. Trust terms are adjusting. Lease rates respond before headlines. They move quietly. They discourage lending. As leasing slows, paper supply tightens. Not immediately. Gradually. Paper contracts multiply claims. Metal does not multiply. Disparity grows. Settlement stress does not require default. It requires delay. Delay compounds. Time enters through queues, through shipping windows, through refinery schedules. This is early-stage pressure. Not acute, but directional. Market participants sense inconvenience. Longer waits. Higher carry. Inconvenience alters behavior. Hedging shifts. Positions shorten. These are partial adjustments, not exits. Rebalancing. Some options narrow. Not eliminated. Less attractive. Physical settlement becomes less trivial. Paper convenience loses edge. Preference shifts incrementally. The system adapts without announcement. Rules remain unchanged. Outcomes drift. Metal flows continue. Paper trades continue. Alignment loosens. Nothing forces resolution yet. Clearing still works. But margins thin. The structure holds under tension. No rupture. No release. Operations proceed with caution. Procurement plans extend. Buffers are watched. The system is still operating. Comfort is reduced. Flexibility is conditional. Paper systems tolerate imbalance through rollovers. They postpone reconciliation. Metal does not. Once physical flow is constrained, math asserts itself. Not ideology. Arithmetic. Annual mine output grows slowly. Official demand compounds. Inventory absorbs the difference. Compounding is quiet at first. Then linear tools fail. Gaps widen. A growing annual deficit persists across cycles. Not dramatic. Consistent. Consistency matters more than size. It converts flow into stock. Stock disappears. When stock thins, leverage loses cover. Paper claims rely on float. Float is shrinking. This removes one option. Infinite paper expansion against metal. That reaction set narrows. The system responds by repricing time. Longer settlement windows. Higher carry costs. Time becomes a cost center. Delay accumulates. Tolerance erodes. Another option fades. Rapid arbitrage between paper and metal. Friction blocks speed. Arbitrage requires delivery certainty. Certainty degrades under load. Spreads persist. Persistent spreads signal math failure. Netting no longer clears fully. Gross exposure matters. As exposure matters, risk models change. They shorten horizons. They reduce size. Reduction is not exit. It is compression. Capacity tightens. Compression concentrates demand in safe channels. Gold sits there. So does settlement risk. Central banks act on settlement math. They accumulate to cap exposure, not to speculate. Recent official buying exceeded 750 tons, near historical records. This locks trajectory. That scale removes another option, waiting for markets to self-correct. Self-correction needs supply. Supply cannot accelerate. Permits lag. Energy caps output. Recycling cannot fill gaps. Quality constraints apply. Throughput is limited. Thus accumulation stacks. Each year adds mass. Mass increases inertia. Inertia introduces time pressure. Not urgency. Direction. Every cycle adds claims faster than metal. The ratio drifts. Drift compounds. At a certain ratio, confidence adjusts. Not collapses. Adjusts. Adjustment means higher collateral standards. More haircuts. Less acceptance. This removes another choice. Cheap settlement through paper alone. Metal regains weight. Dollar instruments remain dominant. But dominance now carries conditions. Conditions multiply. Access narrows at the margin. Not uniformly. Selectively. Selective access changes behavior. Institutions preposition assets. Gold qualifies universally. This is not a prediction. It is accounting. Balances must reconcile. As time passes, inventories approach thresholds. Not zero. Sensitive. Sensitivity amplifies small shocks. Delivery delays matter more. Queues lengthen faster. When queues lengthen, pricing incorporates scarcity. Not panic. Cost. Cost feeds back into demand timing. Earlier buying. Front-loaded procurement. Front-loading accelerates drawdown. Drawdown tightens further. Loop forms. This loop is mathematical, not psychological. It runs while operations continue. At this point, some responses vanish. Short-term leasing to calm markets. Leases are withheld. Another response fades. Assuming futures alone can clear. Delivery clauses matter. The system still operates. Clearinghouses function. But buffers are thin. Thin buffers convert noise into signal. Small imbalances propagate. Stability looks fragile. This fragility is not collapse. It is constraint. Constraint governs outcomes. Central banks hold metal because math requires it, not because of belief. Belief is irrelevant. Dollar options narrow quietly, not removed. Priced. The system enters a tense equilibrium. Working. Less forgiving. That is the condition observed. No drama. No resolution. This channel documents such mechanics. Cold logic only. No promises. Subscribe for continued analysis. Membership supports depth. The system keeps moving.